So welcome everybody to today's webinar. Today we'll be discussing new ways to thrive and grow in this rather, let's call it tricky market environment. My name is Barrett Ayers. I'm the president of Adhesion Wealth. Adhesion's a managed account platform that offers advisors a whole host of outsourcing solutions, including build your own managed accounts, UMA strategies, separate accounts, direct indexing, tax and tax transition services. Basically everything you need to outsource investments if you're an advisor, which is a little bit of foreshadowing into today's webinar topics. So then joining me today are two industry veterans, and I'm really excited that both of you could make it today. First off, Rich DeSalvo. He's the founder and CEO of F3 Logic. F3 Logic is IARs and RIAs, the middle and back office support they need, and the freedom to evolve their professional and business structures over time. And also Tony Leonard is the vice president at MidCap Advisors. It's a New York boutique investment banking firm providing sophisticated financial advice and M&A transaction services to private companies. So gentlemen, thank you both for joining me today.
So, hi, Barrett. Nice. Thank you for the time today.
Yeah, thank you, Barrett, and appreciate it.
Absolutely, glad you both can make it. So in my opening comment, perhaps it was a little bit of an understatement when I said we're in a tricky environment right now. Maybe a better way to say it is we're really in an unprecedented market cycle with a whole bunch of, different levels, right? Certainly, you would need to empathize with anybody operating an advisory business in this challenging landscape. If you're an advisor and you have to deal with business factors like, new forms of competition, pricing pressure, eroding margins, plus a challenging investment backdrop with things like, market volatility, geopolitical turmoil, political stress, then you have to factor in the impact it has on an investor's financial plan. Things like, the assumptions that go into a retirement plan and retirement goals like rate of inflation and quality of life and what we see as the flattening of a yield curve. Then you've got this 24/7 droning news cycle to amp up client anxiety. It's enough to drive almost anybody out of the business. Others, however, and I think myself included, say, take a deep breath, step back, take a look at what's happening, and maybe you call it a unique opportunity to demonstrate not only the value an advisor brings to a relationship, but also maybe a once-in-a-lifetime opportunity to optimize the value of your practice. So I think in terms of stress, in times of stress like this, we're presented with this unique opportunity to differentiate and thereby create a competitive advantage, which of course is the key to maximizing your practice value, is taking advantage of a competitive advantage. So let's talk about maximizing practice valuation for a second. Rich, let me start with you first. Okay. So given your unique vantage point of the market, what are you talking to advisors about in terms of maximizing their practice value?
Well, I'll tell you, it's funny. When you started talking about all the things and the moving parts going on out there, what's happening is advisors are so busy doing. I asked them, what are they actually building? And what they start to realize is in many, and they tell me about their businesses, really what they start having, many of them, I'm going to call lifestyle practices. They make a very good living. However, if they're one or two part-time or one full-time employee gets sick or something happens, they really have an issue. So the question I like to ask them many times is something like this. I'll say to them, can you be in two places at one time? If the answer is no, you're a lifestyle practice. But if you've got great backup and great depth and you can answer that question, I can be in two places, well then maybe let's start looking at you differently. Maybe what you're not, maybe you can become a high margin, quality, sustainable business that has long-term revenue streams even after you leave the practice. Now you can start to be a business. So for many advisors, Barrett, it's really, are you a lifestyle practice or can you be a long-term practice? And that's where Tony's business and his firm, or valuations with a capital V, really start to come to play.
And I would assume then that as firms transition from what you would call a lifestyle practice to something that's more institutional and enterprise oriented and obviously very scalable, we also see things in terms of the spectrum of valuations, I would assume, right?
Yes, that's correct. It's
And that's
correct.
and I guess, and that's a good segue, Tony. So what about you? Obviously you're with your focus a little bit more on the M&A side. How are your conversations with advisors going? Are there blind spots you're seeing? Do you concur with the idea that, as advisors kind of create institutionalized processes and workflows and, become something very scalable, their valuations also tend to increase exponentially?
Exactly. And we see that all the time, meaning that you'll have two firms that are financially identical. And they both have 4 million in revenue, 2 million in EBITDA, and yet their multiples are so much different. One is getting a 12 and the other one is getting an 8. And the reason the firm is getting the 12, they are more of a business. And Rich was spot on when he said that a lot of these firms are a lifestyle business. And I see many of those lifestyle businesses. But what separates everyone else from the rest of the pack is that elite advisor, where they basically have a great business that provides them a successful lifestyle. And so it goes back to what are they doing differently? And I think it's a couple things. One is when a buyer looks at, the financials, and they're looking at a couple things they feel is very important. Priority number one is positive revenue growth. They don't want to buy an organization that's been relatively flat when you take out all the market appreciation. They're looking for a person who's managing the expenses very responsibly. They're looking for a competitive EBITDA. A good EBITDA range, for example, is between, say 40 and 50%. So if you're lower than that, you're spending too much money. And if you're higher than that, you're doing too much as an owner because you spread too thin. So all these different factors have a huge impact on the overall valuation.
Yeah, so that's fantastic. So I guess, are there common success traits that you see from advisory firm to advisory firm? I mean, you talk about, you describe the P&L, right? And so you can look at some of the topical factors and understand what looks really good from the surface. Are there things below the surface that you're seeing in terms of really successful traits that advisors are exhibiting to help get to those EBITDA multiples that you just described a moment ago, Tony?
Exactly. And those factors can be such things as they have a very strong revenue stream that is recurring, because some of the advisors out there might have some old commission basis. So they'll kind of like discount that versus their fee-based recurring revenue. And then they're looking at how diverse is this particular practice. Are all their clients north of 70 years old? That's not a good fit. They worry about that. Another good trait is that we see more and more happening is the actual owner has a successor already lined up and working for them. So that way they can make this a smooth transition. So all these different factors have huge ramifications on evaluation.
And I'm going to share some qualitative on that, Barrett, that Tony just said. And one of the things that you're going to find, and we deal with this all the time, is firms that may want to acquire you are going to look at something like this as you're talking at the dinner table with them. They're going to give the old dinner table test. Make sure you don't slurp your soup, first of all, okay? That's the first thing. And the next thing, they're going to answer themselves this question. Why do people give him or her money? And they want to see it through the table. They want to see the trust. Really what they're looking for is someone that they themselves would give dollars to, and someone, an advisor that wants success for their client more than the client even does. That's what they're looking for, because that's what creates, as Tony talked about, the retention. Look, nobody's buying someone else's hot stock tips anymore. It goes much deeper than that, doesn't it? It goes into who you are, what you do, what type of entrepreneur are you, what type of person are you? Are you trying to still find your unfounded self? They're looking for people like that, because advisors, right? They want some that are going to continue to grow, because the clients are still growing. Are they even growing with their book as people?
Yeah.
And I agree, Rich. And one of the things I see buyers asking is, if you look at your business, how much of that is on a referral basis? And if it's less than 25%, I got to tell you, the buyers are not interested, because as you said, Rich, your clients want you to do well as a business partner. So they're willing to give you names of friends of their family, as well as, colleagues or friends, what have you. to help
And
you.
lastly, on that topic, this, by the way, is a nice little test all the people can be at home can be listening to. But think about this. Let's say, for argument's sake, you're currently at $100 million AUM. Where were you 5 years ago? So subtract out market appreciation. So did you really grow? It's kind of like taking out the alpha on returns, right? Where are you really? What is your real organic growth sans market appreciation? So be careful when you were a $50 million advisor, and then the market appreciated, now you're a $100 million advisor. But the truth is, you're really a $50 million advisor, and the market got you there. And the buyer will see that.
And for that reason, Rich, when a buyer puts together like an earnout package, one of the things they'll do is say, all right, the first 5% of the growth, you're not going to get any credit for it. So it's that growth above the floor where they say your earnout is going to be structured. So that's what you'll get the calculation on. Because like you said, the easy part is keeping the clients, if you will, and participating in the market appreciation. And I tell you, another test of a really good business is if that owner goes away for 6 months, what's going to happen to the business? 6 months from now, is it still going to be afloat? Are people going to go on looking at each other? Who's going to take care of this? What about that? A really successful business can have the owner go away for 6 months and all the operations continue to run very smoothly. It's a classic example of a great run business.
Yeah, I think that, I mean, that's really just a different way of saying what Rich said earlier. Can you be in two places at the same time? And if you can't do it, you have a lifestyle practice. I think that's a good litmus test. So, Tony, a moment ago, you mentioned earnout. And I think, we've talked to a lot of advisors who think about growing and exiting as if it's, kind of like once you're done, you're done. You sell the business, you hand off the keys, and you walk away with a big payout. And I assume that is probably a common misconception. Typically, earnouts, I assume, last multiple years. The principals stick around. First of all, is that accurate, would you say, in general? And what other misconceptions have you talked to advisors about when it comes to selling their firm?
Well, and you're absolutely right. That is one of the biggest misconceptions that, like you said, Barry, hey, you sell the business and it's off to the beach the rest of your life. That's the last thing the buyer wants, is for that owner, as well as its key employees, to leave the organization, because they realize the secret sauce is everyone working together and taking care of the clients and growing the business. And so they don't want that key person to leave. And that's why they put together, that type of strategy where they say, all right, if you're able to grow the business, we'll give you another reward after 3 years. And the best thing about it is when you sell your business, not only do you get that money up front, tax on the cap gains, but as well as the 3 years from now on the earnout, that's tax gain, that's tax out of capital gains. So it really behooves that owner to stick around and help grow the business for additional revenue. But that's another one. And I think another big perception is, and I hear this all the time, well, Tony, I'm going to do this till I drop in at my desk type of thing, that they're going to do it in their 70s and their 80s, if you will. Well, and one of the things I always ask them, well, are you a fiduciary? And of course, everyone these days is a fiduciary to the plan. I saw a commercial last week during the Final Four, and one of the mutual fund families said, we're a fiduciary. And I'm like, wow, do you breathe oxygen too? That type of thing. But so back to the fiduciary status. Well, if you're a fiduciary, one of the biggest tenets is the tenet of care. And you need to have a succession strategy in place. And according to the latest study, around 45% of the business owners do not have one in place. So they need to have that in place.
At a time when the advisor community as a whole is aging, right? So you've got this problem where you've got advisors aging, yet very little in the way of succession planning. So there's a gap there, right?
Absolutely. And, I was at a big retirement plan conference last week, and I think the theme color for the whole audience was gray, meaning everyone's getting old and gray. It's an aging population. And
sorry, Tony.
but I think one of the biggest statistics out there, we now have more CFPs over the age of 70 than under the age of 30. Wow. So that tells you we're in an aging population here.
What were you going to say, Rich?
Barrett, to your point, think about this for them too. Let's just say someone doesn't have a succession plan, right? And they can't pass that 6-month test or be in 2 places at one time. You go to look to sell your company. Here's what's going to happen. They, being the buyer of your firm, knows now they have to go and hire someone. So let's just say, for argument's sake, because it's very simple math, it's $100,000. It's going to be more than that, but let's put a realistic number. It's $200,000 a year to replace you. Well, they're going to take that off of your EBITDA times the valuation factor. So let's just use a number of 10 because it's simple math. That's $2 million that's going to come off of your price because you had a lifestyle practice and chose not to fill that void while you were working.
Yeah, it's a significant impact. And I think most advisors don't think that way. We certainly don't hear folks talking about that. But of course, having said that, maybe we got ahead of ourselves in our conversation, right? We're already talking about exiting the practice. Well, maybe we backfill a little bit. We talk about how do we get here in the first place, right? So we talk to advisors all the time, and we generally talk about it in 4 large phases of growth, especially for the folks that are breaking away or thinking about going independent. We talk about launching the business, growing the business, then scaling the business, then transition or exit. And sometimes advisors are surprised to hear us say, well, I thought growth and scale were the same thing. And really they're not, right? You know, when you're starting a business, the things that you do to grow a business are much different than the things that you do to scale a business. So let's talk about that for a second. One of the things that we think is a really important things for folks in the kind of in the growth phase, moving to the scale phase, is outsourcing, right? We think outsourcing is a really good way to accomplish growth and kind of set yourself up for scale. So we talk about that for a minute. It's a really good way to accomplish the theme that we keep talking about. How can you be in 2 places at one time, right? Free yourself up to go focus on what's core. So Rich, help me out here a little bit with the way your business works and the advisors you work with. What kind of things can advisors do to free up their time vis-a-vis outsourcing?
Well, so first of all, with the outsourcing, remember too, if you're looking at the screen too long every day, there's an issue. So number one, and I also will share with you, I don't necessarily think using just a custodian's platform will actually give you enough. They've got a platform that's really, my words, the bare minimum. It works, but that's about it. It's fine. But to have a quality practice with all the accoutrements that are out there, you need more than fine. And also trading. Remember, if you're an RIA and you're trading errors do happen. And they do, and you will have to pay the difference, and you're going to be responsible. So a firm like Adhesion, right, can certainly help you reduce liabilities. But really where you're going to see also a difference is when you outsource, and think of it very simplistically. You've got one client at $1 million, and that's your business. Just oversimplify with me, and you're earning a 1% fee. Well, now you've got the fees of the software that we just talked about, right? Who actually pays for that, or how is it paid? If it's taken out of the 1%, you're just killing your EBITDA, aren't you? But if you take it out at the account level, your 1% that you keep or charge is the 1% that you almost pretty much keep, sans rent or some compliance. So your margins are going to be much higher when you bill at the account level. So by outsourcing also, you don't have to hire staff. Because if you did, that will come off your EBITDA also, doesn't it? That $1 million gets shrunk very quickly. So imagine at the account level, someone like my services or Barrett services can be paid, when I say at the account level, or by the plan, by the participant. Said another way, it's coming out of the yield because it's coming out of the account, right? But it's not coming out of your EBITDA. So really the client, your client, is paying for our services. Very good business model.
And in fact, if you go one step further and you take the example that you just demonstrated a minute ago, what a $200,000 impact has on your ultimate EBITDA exit multiple, a $200,000 investment is meaningful. Yeah. So in fact, we talk about this all the time. We talk about, and it has the potential of being a net zero, net sum game here, where, the cost of what it takes to outsource to somebody like Adhesion can be borne by some of the asset managers on our platform. As an example, you could go from a mutual fund at, let's say, 100 basis points to using a separate account manager at, say, 30 basis points, tack on a little bit for Adhesion, and suddenly your client is potentially paying something that's a little bit more affordable. You don't have to be in there running the rebalancing and the trading and all the administrative work on the operations of the business. And you're also not paying, you know, a couple $100,000 to traders and portfolio managers and software and, you know, all the risk assessment capabilities to put on top of it. So it's an easy way to not only improve the EBITDA margins, but also have consistency and predictability in the way that the business is run. When you have 100 accounts and they belong to 100 different models, I don't know who's going to step into that business and run it, because each account is kind of running its own way. But when you have something that you've got 100 accounts and they're tied to 20 models, and there's, you know, rigidity there and structure and discipline with the way they run, and a buyer comes in and sees the documentation on each one of the strategies and how they work, they know that they can easily step in for a principal who may be departing in a year or two, right? So certainly from that perspective, we think outsourcing is a great way to not only create operational efficiency and scale, but also economic efficiencies. So let's take that advisor then. Let's say that advisor now has gone through all the best practices we talk about, and they've effectively scaled their business. The dollar they invest in the business today yields the same, if not greater benefit than the $10 they invested last year, right? So they're achieving this scale curve we talk about. And they conclude it's probably it's time to start looking for some sort of exit or transition, whether it's succession plan or exit or retirement or something else. Business valuations and understanding what goes into it is important. I think to a lot of advisors, it feels like, you know, alchemy. So I guess help us a little bit more with some of the key metrics on the exit. I know we talked about, you know, gross revenue. We talked about, I think, net revenue. We talked about EBITDA. Are there other non-revenue, non-financial metrics that are interesting? I know you talked about the demographics of the client base. What about things like, you know, number of advisors to accounts, or any other statistics like that, Tony, that might be relevant for advisors to kind of understand how this all works?
You know, Barrett, I would say all of those contribute to a very successful EBITDA, because at the end of the day, that's what the buyer is getting, and that's what they're purchasing. So whatever the owner can do to really fine tune that EBITDA, like you said, will pay handsomely for them when they go to sell their business. But you got to be careful, because these buyers are very sophisticated, and they might have a team of 10, maybe 20 people reviewing those financials of the seller. And what I mean by that, so if your EBITDA is too high, they'll realize, wait a minute, this person stripped out a lot of these expenses for those very reasons. He or she's going to get a 10 return for every dollar they cut. So they look down and say, wait a minute, we looked at the tax return 2 years ago. They had 10 employees and now they're down to 5. What happened? And well, they're stripping the business to get that higher EBITDA, if you will. And the same could be said on the other side of it, is they're spending too much money, kind of like what you said. They're not outsourcing, but they're buying all this resources and hiring all these people when they really don't have to. And they would be a lot better off by outsourcing it to improve their overall EBITDA. And so, and that's really the purpose of evaluation, to really not only look at the revenue, the expenses, the EBITDA, but look at the benchmarking within all of those expenses, you know, whether it be occupancy, the income of the owner or the staff, how much money are they spending on technology. All those come into play when you go to calculate your EBITDA. So, and one last thing I will say about that is, another flaw of these business owners, they think it's easy to sell their business, meaning that all I have to do is put a sign in the front yard. Well, if you use the analogy of selling your house, you don't wake up, well, granted, the housing market is absolutely crazy these days, but typically you don't wake up in the middle of the spring and say, well, let's put the house on the market next weekend. Chances are what you'll do is you'll look at the house and say, wow, you know, we haven't painted this thing in 10 years. The landscaping, the trees are dying. We got shade carpeting along with Formica counters. You need to upgrade it. And it's the same they need to do when they take a look at their business, because so many of them don't make those necessary changes. They wait to the last minute, and ultimately it hurts them in their overall price.
And Barrett, with what Tony just said, I think a simple way that I've shared it with advisors, think about if you as an investor, right? You invest for your clients and you were going to buy a bond and you want to do some due diligence, you want to get the credit rating on that bond, because why? You're putting the $1,000 in the bond, and you want to make sure you're going to get back your 7% interest for the next 30 years, right? You've got to do due diligence. Well, the buyer's doing the same thing. You're like a bond. They want to make sure that money's going to keep coming in. So they're going to look at the streams of revenue that was all mentioned, including you, right? As the CEO of that bond, they're going to make sure the money keeps coming in. And the second, so just please understand, during this process, you have to be humble, right? And I'm going to define humble as where it's the acknowledgement, right, of one's inefficiencies and the willingness to learn. I think you have to go through that exercise because you see the street, you hear the word that there's a firm that got 15, we know 20x, 21x was the high that's recently hit. And all of a sudden you think, that's my company, that's me. Well, just understand, be open to the possibility. You're not at 21, have some humility and go learn the facts of what can you do to get to 21 or as close as possible.
Yeah, that's fantastic advice. Tony, were you going to say something?
Well, Rich, if you know anyone offering 21x, please let me know.
Well, there was, as we know, one deal was done out there at that level, and I think people thought, like real estate, my neighbor's house sold for that price, so that's now the new price of my home, and that's a dangerous assumption.
That's a high watermark. That's right.
Well, and to your point, Rich, about humility, which is a key factor, to me, one of the most amazing things is when you sit down with an RA and say, all right, what happens if you have a $10 million prospect? And they're going to start off with this whole thing. Well, we're going to do an asset allocation. Then we'll focus on the portfolio structure. We'll do all this due diligence on the money managers. Are we going to go active, passive? What's our rebalancing strategy, reporting? And they do all this great stuff. Then I ask them, all right, that's a $10 million prospect. What are you doing for your business that is worth at least $10 million? Are you doing that same type of work ahead of time? And it's like deer in the headlight. Well, I'm going to get to that next year. You know, that's my project down the road type of deal.
Yep, fantastic advice. So look, we're running up against the bottom of the hour here. We got about a minute or two left. I got one question I can take, and that's about it. We've got a bunch that have come in. I'm going to add, yeah, like I said, I've only got one. And I'll ask this maybe to both of you guys to see what you think about this. Interesting question. So how much longer can the seller's market continue in the wealth space? And I guess, would we first conclude and agree that we are in fact in a seller's market?
Absolutely, yes.
Okay, so no question about that. I guess, who wants to start with that one, thinking about how?
I'm going to go, if I may, Tony, because I think you've got better metrics and live by the experience. I'm going to share with you, I think, what I see in the industry. I think there's a train coming right into the wall on this one. I think you've got a lot of firms using other people's money that are buying advisors at the top of the market. And I think because people still remember the oligopolies in our space haven't been figured out yet, have they? Think about 401k plans, the mutual fund industry, the ETF industry. There's a natural place where there's only 4 or 5 or a few, right, that run the business. That hasn't happened yet in our business. And people are trying. So they think success is buying overpriced advisors at the top of the market. When rates start to move and that big bet of buying high and selling higher, quote, doesn't work, the smart money is going to exit very quickly. So my answer is 2-3 years, tops. I think you're going to see a drastic change.
Interesting. I think, Rich, it might be a little bit longer than that based upon the demographics. Yeah, and as we talked about earlier, it is definitely an aging workforce out there. So, but the private equity firms who are backing a lot of these aggregators, you know, they're still very much interested. I had 2 of them call me today and explaining what they're looking for in the RA marketplace. So they're not backing down from my point of view.
It's fantastic. Well, just, you know, fantastic insights, guys. I can't tell you how much I appreciate speaking with you. I know our audience is engaged and excited about hearing about this. So look, thank you both very much for your time, Tony and Rich. Great conversation. And everybody for attending, we thank you very much. Contact information for Adhesion is down below. And thank you very much for attending, and have a great rest of your week.
Okay. Thank you, Barrett.
Thank you. Thank you, Barrett. Thanks, Rich.
Yeah, bye all.